Welcome back, everyone. So, up to this point, we've really been deep in the weeds of accounting, right? The nuts and bolts, debits, credits, building out those financial statements. And that stuff is absolutely the bedrock. But today we're going to shift gears. We're moving out of the scorekeeper's booth and into the manager's office. We're going to tackle one of the toughest, most fundamental challenges you'll ever face as a leader. This delicate dance between protecting a company's assets and not accidentally choking the life out of it. This is where accounting stops being about just recording the past and starts being about shaping the future. All right, to get our heads in the right space, let's start with a little thought experiment. Imagine you own a business. An expert comes to you and says, hey, there's a 1 in a million chance that a meteor is going to hit your building this year. Now, you could spend millions and millions of dollars to build a meteor-proof bunker. It's technically possible. But should you? Of course not, right? The idea is almost laughable. And why is that? Because the cost is just completely out of whack with the risk. The probability is so incredibly tiny that spending that money makes no sense at all. And that little example, believe it or not, gets right to the heart of what we're talking about today. How do we, as smart decision makers, figure out how much is the right amount to spend, preventing something that might not even happen? And this idea leads us straight to one of the most basic principles in all of business and economics: scarcity. The simple fact is, no company, not Apple, not Amazon, nobody has unlimited resources. You never have enough money, enough time, or enough people. And because of that, every single decision you make is a trade-off. The key term here, and you'll remember this from your econ classes, is opportunity cost. For every dollar you decide to spend on, say, a new security system, that is a dollar you cannot spend on something else. You can't use it for a new marketing campaign, or for R&D, or to hire that amazing salesperson you need. And this idea of opportunity cost gets really, really sharp when we're talking about internal controls, because let's face it, they're usually seen as a cost, not something that makes you money. Okay, so let's put a formal definition on the table. An internal control system. I love thinking of it like a company's immune system. It's not one thing, it's this whole web of rules and procedures all working together to keep the business healthy. Sometimes they're super simple, like, a rule that any expense over $100 needs a manager's signature. Or they can be procedural, like making sure the person who approves payments isn't the same person who writes the checks. That's a huge one called segregation of duties. And of course, they can be really technical, like all the firewalls and login protocols for your computer systems. Now pay close attention to that phrase right there. Reasonable assurance. You have to burn that into your brain. No system on Earth can give you a 100% ironclad guarantee. The goal isn't to be invincible, that would cost a fortune. The goal is a smart, sensible level of protection that helps you trust your numbers, run your business well, and stay out of trouble with the law. So, let's start breaking down this cost-benefit analysis. First up, the costs. Putting a good system of internal controls in place, well, it's an investment, and every investment has costs. A really common mistake students make is just looking at the sticker price. But as managers, we have to be smarter than that. We have to see both the obvious costs and the hidden ones. Let's make this real. Let's say we're rolling out some fancy new expense reporting software to cut down on fraud. Okay, the direct financial outlay, that's easy. It's the $50,000 a year subscription fee, but that is just the tip of the iceberg. What about employee training time? We might have to take our entire sales team of 100 people off the road for a whole day to teach them this new system. You do the math. That's 800 hours where they're not selling anything. That's a huge hidden cost. And then there's the hit to efficiency. What if the new software makes you fill out 15 different boxes just to expense a coffee? And then you have to wait 24 hours for a manager to approve it. That kind of friction can really slow things down and drive your best people crazy. And finally, you've got ongoing maintenance. You might even need to hire someone just to manage the software. All of it. The direct cost, the hidden costs, the ongoing costs, they all go on the cost side of our scale. Okay, so we've looked at the cost side pretty hard. Now let's flip the coin. We're not spending all this money and creating all this friction for nothing. We're doing it to get some really important benefits. And in the world of internal controls, the benefits are usually framed as the losses we manage to avoid. And the benefits of a solid control system are huge, even if they're sometimes harder to put a dollar sign on. The obvious one is preventing fraud and theft, but it's also about avoiding mistakes. A big error in your accounting can lead to a financial restatement, which is basically telling the world, oops, those numbers we gave you before were wrong. That can absolutely demolish investor trust. And for public companies, this isn't a choice. The Sarbanes-Oxley Act, or SOX, basically forces management to say, yes, our internal controls are working, and there are serious consequences if they're not. That's all about mitigating fines. And maybe biggest of all is reputation. Just think about a company like Wells Fargo. The reputational damage from their control failures cost them way, way more than just the initial fines. It's a cost that can linger for years. So this right here, this is the central dilemma. It's a constant balancing act. On the left side of the scale, you've got the costs. They're real, they're certain, they hit your budget right now. You can feel them every day. On the right side, you've got the benefits, these potential disasters you're trying to avoid. But they're uncertain. They're all about probability. And you might never even know for sure if your control system is what stopped something terrible from happening. And that is what makes this such a tough managerial challenge. All right, enough theory. Let's get practical. I'm making you the CFO right now. Your audit team comes into your office, and they look serious. They found a weak spot in your payment system, and if someone exploits it, the company could lose $2 million. Just gone. Now, they have a solution. It's a new software control that would totally patch this vulnerability. The price tag is a one-time cost of $200,000. And based on all their research, they figure there's about a 10% chance this fraud could happen in the next year. So, the proposal's on your desk. The decision is yours. Do you sign the check? Before we crunch any numbers, just what does your gut tell you? Yes? No? And more importantly, why? Now, our gut instinct is a good starting point, but as managers, we have to back it up with data. So let's bring in a really powerful tool for this kind of problem. It's called expected loss. This is a huge concept in risk management, in the insurance industry, everywhere. What it does is it gives us a rational way to put a number on a risk that might happen in the future. It takes this big, scary what-if problem and boils it down to a single dollar value that we can compare to a real cost we'd have to pay today. And the formula couldn't be simpler. You just take the potential financial loss and multiply it by the probability of it happening. So let's run the numbers for our CFO problem. The potential loss is that big $2 million. The probability is 10%, or 0.10. So we multiply 2 million by 0.10, and what do we get? We get an expected loss of $200,000. Now, let's compare. The cost of the new software is $200,000. The expected financial loss if we do nothing is also $200,000. So from a pure by-the-numbers financial perspective, it's a perfect tie. The math alone doesn't give us an answer. And believe me, this happens in the real world all the time. And this, everyone, is where management stops being a science and starts being an art. This is where you earn your paycheck. Your spreadsheet is screaming it's a tie. The quantitative analysis has hit a wall. So what now? Now you have to think about the qualitative factors, the things that don't fit neatly in a formula. For instance, what's the damage to your company's reputation if a $2 million fraud hits the news? What happens to employee morale when they find out the company's systems aren't safe? What do your investors and the banks that lend you money think? The financial loss might be $2 million, but the total damage to the business could be so much bigger. So, in a situation like this, where the numbers are awash, a smart manager would almost always approve the expense, because the risks you can't quantify are just too great. So that whole CFO scenario really highlights the real goal here. The mission is not to achieve perfect absolute security. That's impossible and would cost way too much. And it's not just to cut costs to the bone, because that would leave you totally exposed. A big mistake I see students make is thinking it's all or nothing. The real strategic goal is to find the optimal point, that sweet spot, the point where the net benefit, meaning the value of the losses you prevented minus what you spent on the controls, is as high as it can possibly be. This chart here shows that search for the sweet spot perfectly. Look at the bar on the far left. That's inadequate controls. Yeah, your costs are low, but you're losing so much money to fraud and mistakes that you're actually in the red. You have a negative net benefit. Now, jump to the far right. This is excessive controls. You've probably eliminated every tiny bit of risk, but you've spent so much money and made your company so slow and bureaucratic that you've eaten away most of the benefit. The goal is that peak in the middle, the optimal level. You've accepted a tiny bit of risk, but you've put in a smart, efficient system that stops the big threats, and that gives you the highest possible net benefit. That's the target you're always aiming for. So, let's talk about how you can actually do this and avoid some of the common traps people fall into. When you're in the hot seat making these kinds of decisions, it's really easy to get tripped up in your thinking. Thinking like a strategist means you know what the pitfalls are and you know how to sidestep them. So here are 3 big principles to keep you on track. First, quantify and respect. By all means, do the math. Calculate that expected loss. But you have to have the wisdom to respect the things you can't quantify. Like we talked about, reputation, morale, they have to be part of your final decision. Second, challenge your assumptions. This one is so important. In our example, where did that 10% number come from? Was it a solid, data-driven analysis or just a guess? As a leader, you have to learn to poke at those numbers. Ask, how do we know this is 10%? Because if it's really only 5%, the whole calculation changes. And finally, balance complexity. Never, ever forget that actual human beings have to use these systems every day. The most perfect control system in theory is an absolute failure if it's so complex that your employees are inventing workarounds just to get their jobs done. Sometimes a system that's too complex is actually riskier than a simpler one. And that really brings us to the biggest lesson of the day. The quantitative tools we've been talking about, cost benefit, expected loss, they are absolutely essential. Think of them as your flashlight in a dark room. They light up the facts, they frame the decision, they keep you rational. But they are just tools. They're not the answer. The numbers can tell you what could happen, but they can't tell you your company's appetite for risk. That's where leadership begins. Your judgment, informed by your understanding of the strategy, the company culture, all those qualitative factors, is what turns analysis into a decision. As you move up in your careers, you'll find that the hardest decisions and the ones where you add the most value are in those moments where the spreadsheet ends and your judgment has to take over.